shaky at the moment. I think that's the easiest way to put it. But need to add, pull one thing open real quick, and we're going to dive right into this. I hope everybody's enjoying your day. Good morning, traders. We're going to dive into a little bit today that we have talked about in the past, but it bears repeating because of the way that this market operates and the way that opportunities have emerged over the last few days. Obviously, momentum remaining strong. We'll do our morning checklist as we usually do. And then from there, we're going to take it into earnings. And we'll talk about short squeezes and one of the other key trends. Oh, and what is the answer is Cactus, by the way. That is a Chicago bar and restaurant that does not exist anymore, but it was a trader's bar. And I did not want to put the series picture up. All right, 9:30 in the morning. Why do we do what we do? Well, we get up because exit liquidity at 9:30. And this is going to be more important than ever tomorrow when we have Google and Tesla reporting earnings. So I want to get you in the mood and in the kind of spirit of understanding that at 9:30, if you're not prepared, you are exit liquidity for the broader market and for the repositioning of this market as we head into the depths of earnings season. And we start to see a lot more action and movement in this market due to earnings, due to the Federal Reserve. And once again, we now have a new trade deal. We still have other trade deals that we're going to have to tackle over the next couple of weeks. But that said, we will discuss some of the little changes that have happened in momentum and why it is very important over the next couple of days to start to think about and position yourself for the possibility of a market top heading into August, and then seasonally one of the worst periods of the year, if not constantly the worst month of the year historically, which is September. We got to start thinking about that now. On the macro side, the United States has saved SoftBank. Well, that's what I'm going to argue, at least. The United States deal, U.S. trade deal, sparking a global rally, if that's what we're going to call it. But tariffs on Japanese autos dropped from 25% to 15%. And this is really just a matter of risk on for the time being. We look at the futures market today, kind of looking, chapping around. We are back up to, well, new highs. We are on the verge, cusp of getting back to 45,000 on the Dow. NASDAQ at 23,000, and the Russell remaining strong above its moving averages. The Nikkei got a big boost today. And that is critical because, as we have talked about, Japan still seems to be the canary in the coal mine for the global markets. We have significant concerns about their banking system. And I think, obviously, this deal provides a little bit of cover for some ongoing problems that remain there. That said, keeping a very close eye on all of the momentum that gets boosted out of this. You have HMC, Honda Motor breaking above that 20-day moving average. It's up 10% today. Big move up to 33. And we are now back at levels we have not seen since October of last year, when a lot of the sentiment and a lot of these concerns actually started. In addition, Toyota Motors, TM, getting another boost today, up to $12. Remember, a lot of people have been taking aim at some of these stocks. Once we get back above these levels, momentum, can we retest? Can we get up to that $200 level on TM, consumer cyclical stock? This is beneficial for us, but at the same time, you pay very close attention to General Motors, which just came out with this warning about the impact of tariffs. General Motors now hovering around that 200-day moving average. Again, it falls on our F&Z score stocks. If you want to try to play a little bit of a recovery on General Motors, you may, but make sure you keep that stop right at that 200-day moving average. A lot of concerns still dissipating for U.S. companies. We look across with the SPY, the QQQ, and the DI. This is a big day for markets because it is the kickoff to earnings for the Magnificent Seven. So Alphabet and Tesla will report after the bell. I dug deep into Tesla's earnings report yesterday, what to expect, the types of trades that we can anticipate. For Tesla, it's all about margin pressure and robo-taxi speculation. And for Alphabet, it's about strong AI, cloud, ad growth, and more. But keep this in mind. The market does not reward earnings. The market rewards shifts in expectations. So we're going to see unwinding of positions. We're going to see a significant amount of hedging. We're going to see a ton of straddles and strangles and options and plenty of positioning ahead of these reports. I encourage you, if you are watching dark pools or you're watching options, watch the last hour. Don't be paying attention to what's been going on in the last 24. Look and see if anything significant changes around 3 o'clock to 4 o'clock today, and look for some movement in Tesla and Alphabet as funds and other groups jockey for position ahead of the 4 o'clock hour. Paying very close attention to Google, GOOGL, and Goog, and obviously Tesla, and all of the proxies that are tied to these names. Tesla is not just going to impact Tesla tomorrow. It's going to impact the SPY. It's going to impact the Qs, but it's also going to impact other U.S. companies like Ford, General Motors, BYD over in China. It will impact companies that are in the energy storage space. It's going to impact companies that are in the auto space, the AI space, and even links to crypto. So today, very important day for Tesla, and there are going to be at least 15 to 20 stocks to actively day trade tomorrow on the back of Tesla, and at least another 10 to 15 off of Google. We'll be digging into that today at 12:30. Very important session that is part of Theo Live. Get in the room with us. Again, click the link, join us. We do this all day live. And now the opportunity with our focus on earnings this week and into next week, plus the Fed meeting next week, there is an ample amount of opportunity in the next 9 days. These are the types of days that will make your year. The final key thing on the macro side is GE, Vernova, absolutely breaking out. One of the top stocks that we have been focusing on in the alternative energy space. Extremely strong momentum on the backside of that April move, 324 all the way up to 490. I've been just talking about this stock since I went out to Utah in March. The company just continues to move higher on turbine demand. TXN, however, on Texas Instruments, this is where the weakness and the concern for the market is going to lie over the next 2 weeks. What is happening with semiconductor stocks? We're seeing weakness in Texas Instruments, big move down on lower chip demand and concerns about tariff. And that brings us to the absolute most important thing to watch in the next 24 to 48 hours, particularly with Google reporting earnings today. SOXL. The SOXL is the triple bear ETF for the semiconductor space. And when this starts to break down, this can create a significant amount of concerns in the broader market because, once again, this is tied to index swaps. This is tied to leverage. And if we start to see funds and other companies start to delever from semiconductor stocks, it can lead to a pretty pronounced downward move in the SOXL and the semiconductor ETFs and the underlying companies. Micron will be in focus for the next couple of days as well, but I want you to pay very close attention to the SOXL and see if it can rebound and find momentum. That can take us on the next leg up. But if we start to see continued weakness across the board on semiconductor stocks, obviously what goes up will come down. This can put a lot of pressure on NVIDIA as well, even though it is the most dominant player in the space. Watching that. The other third thing is in the defense stocks, plenty of geopolitical tailwinds, LMT, NOC, RTX, all those names in focus after earnings. Once again, looking for some particular movement here, but once again, RTX getting beaten up a little bit of a rebound on, on Lockheed, a little bit of a rebound on RTX and NOC. We like these companies for the long term simply because this is something that's not going away from the U.S. budget. There is going to be a little bit of shifts, looking for some selling in Northrop, looking for some rebounds in Lockheed. Remember that the U.S. government does prioritize the companies that are lagging in the market. We've seen that happen going back to 2021. Core themes at the macro level, though: global rotation, back into risk, Bitcoin remaining very elevated at $117,000 when I was looking at it this morning. High volatility is expected with earnings ahead. and we are looking at very specific sector momentum plays. So as always, just go to groups, pay attention to where capital has been moving over the last week. Interestingly enough, very strong performance in the utility sector that we have seen over the last week. This is a reminder that utility stocks are trading more and more like growth stocks because of the AI story, because of the power story, and because electricity demand is going to continue to increase on the backside of this decade, and then it starts to go exponential from 2030 up to 2050. So the markets are pricing in strong growth on the utility side, and we're going to talk a little bit today about what we have called the hedge of tomorrow and why this is one of the places where there's a lot of ample opportunity to make money in terms of yield that can be utilized for the purposes of trading on a day-to-day basis with assets that will appreciate in value, protect against inflation, but also kick off a lot of cash that you'll be able to utilize to trade. Good. All right. So no questions yet. That's good. 23%. Okay, good. Making sure, just paying attention. The SOXL isn't the bear. It is the bull ETF. If I misspoke, I apologize. The SOXS is the bear ETF for the semiconductor stocks. We do not start to sound the alarm unless we move above that 50-day moving average. And obviously, we're a little bit away from that. But as you can see, not a lot of great things have happened in the semiconductor space when we break above that 50-day moving at 50 and 20-day moving average. We'll talk a little bit more today about how to trade this. Pay very close attention to NVIDIA if it breaks under its 20 and its 50. While the SOXS is breaking above its 20 and its 50, we got a little bit of a problem in the semiconductor space. That is what is on alert. All right. Why are the memes back? We'll talk about that. Great question. We're going to talk about that in about 5 minutes. All right. Broad momentum, 18, 19 on the reading. This again, we do this every day. The key focus here is the number of stocks breaking out versus breaking down. A very poor man's version of this. I don't articulate the coefficients that go into the broader reading, but from an intraday perspective, we have 19 more stocks breaking out than breaking down in the S&P 500, according to the bell curve that we utilize. In the event that this number goes negative and we start to see the FNGD breaking above its 20 and its 50-day moving average, we know that the leverage and the capital that is flowing out of the S&P 500 is at the top and not really coming from the bottom 493 stocks. Remember, most of the leverage and most of the investing goes into that Mag 7 side. Significant amount of capital tied up in those stocks. So right now, moving strength. FCX, we've talked about FCX multiple times. We've seen Blake make great trades on Freeport in the past. FCX rebounding, bouncing right off that 20-day moving average. This has been a theme going back to April, where the stock will test its 20 or its 50. It has obviously tested its 50, tested its 20, tested its 20, 20 and 200. Did not get down to its 50-day moving, is now turning right back around. Strength in commodities, and we'll talk a little bit about that momentarily. This is just about a world that continues to print money, continues to expand and refinance debt, and basically all commodities are basically in play when this continues to occur. This has been the major trend of the markets for the better part of 15 years. Albemarle, lithium, right? Pushing toward overbought. Pay very close attention to this. Strength can create more strength. We're looking for a little bit of a reset, maybe a retest of that 200-day EMA, but that becomes a buying point and line in the sand. Very strong momentum remaining on this backside for Albemarle. Colm, name I haven't seen in a long while, but that is Columbia Sportswear. We've discussed the consumer cyclical stocks. We've seen GIII. We've seen some of these other names. As this pushes toward its 20, we will probably be looking to do a trade built completely around this. Strength on virtually every single indicator that we're looking for. I'd like to see the MF5 remain elevated, but moving toward that 55 level on the RSI on the daily, MACD, ADX looking strong, a very low ATR. Looking for a nice little rebound on Colm. not going to enter that until we are back above the 20-day EMA, but we are right within an earshot of that. Vistra and BLDR, both names that you know, we've talked about them in the last couple of weeks. On the weak side, Netflix is still under pressure. And there's going to be a lot of attention for this stock as we look for earnings today from Tesla and Google, obviously. But that said, momentum does remain weak for Netflix. It has been beaten up since the backside of its earnings and had been selling off into its earnings. The key reminder is that weak momentum creates weaker momentum. And ultimately, we're looking for persistent weakness until there is a reason to jump back into this. VG, another name that we're paying attention to is Venture Global, breaking down as well. Energy side, that is on the back of what we talked about yesterday. The OILU was going to look to retest its 20 and its 50, but the overall expectation, we're going to see if we can get a rebound on oil in the wake of this trade deal. There still are those catalysts and those concerns about an agreement with China, and we have other trade deals that need to exist. For the moment, oil price is still moving lower, despite the fact that we had that trade deal. Today's watch list, again, we're paying very close attention to Lockheed and NOC and RTX. There are reversion potential opportunities there. LAGN, which is a company that is in the dentistry business, seeing if it can get back above that 20-day moving average. And finally, KEP, Korean Electric Power, which has been one of the strong F&G score stocks that we've discussed. Looking for a rebound here and paying very close attention to that 20-day moving average. That is the FG20 strategy, which we've outlined earlier this week. Final stock, KSS. Brandon nailed this, and this is from Ghost Prince. Stock had a huge squeeze yesterday. Total return 350% initially on that trade, which brings us to the conversation for this morning. Short squeezes, right? Short squeezes. So what oil trade deal happened? There is no oil trade deal. There is an agreement between the U.S. and Japan to ensure that the auto tariffs are down to 15%. That agreement is supposed to be bullish for oil because it's strengthen economic activity and does not create a significant impact on geopolitical and economic bilateral trade between those nations. But that said, oil markets are not reacting positively to that at the moment. It seems that the oil market remains somewhat concerned about a deal between the U.S. and China. All right, what is a short squeeze? Now, I know a lot of you know this, but it really is a question of like, what is the optimal way to address this? Because someone just asked, why are the meme stocks back in focus? And we'll talk about that TXN and Intel question momentarily. Intel is back in focus and could easily face the same pressures. Again, it's all about foundry issues, and it's all about the question of semiconductors. Pay very close attention to the SOXL and what it is telling you ahead of those earnings. That said, why are the memes back in action? Well, the memes are back in action as we laid out when we were talking about the idea of what are reversals in the market? What are the top signals? Historically, when we're looking for bottom signals in the market, we look for insider buying activity to pick up. We look for policy pivots. We look for things along the lines of people stepping in and buying value. We see a lot of money start to pour back into high beta stocks. Those are typically the signals that the worst is over. But how do we know in an environment that the market is stretched? One of the things that historically has been shown is that we see a lot of money flow into companies that have no business from a fundamental perspective getting squeezed. And what is a squeeze? Well, a squeeze, keep in mind, what happens is you have a heavily shorted stock, and over at highshortinterest.com, there is a list of NYSE, NASDAQ, Amex stocks that are heavily shorted. What does this mean? Well, right now, there is a float for a company like Wolfspeed, a semiconductor player, of 154 million shares. 49% of those shares are being borrowed, sold into the market on the hope that they will decline because the person who is selling it wants to be able to buy it back for a cheaper price, pocket the difference from what they sold it for and what they bought it back for, and then return the shares to whom they borrowed the stock from. A short squeeze occurs when heavily shorted stocks start moving sharply higher. And that forces those people who sold the stock into the market to buy it back. And sometimes things can get out of hand because if the stocks really move up higher really, really quickly, the people who sold into the market for, say, 50 now have to buy it back for 75. That means they lost $25. The difference between buying it at 50, subtract the 75 gives you minus 25 per share, plus the fee that they paid to borrow the stock, whether it's from an ETF or a fund or someone else. So short sellers borrow the shares they sell. They hope to buy it back cheaper. If the prices rise rapidly, they face losses they have to cover. That buying creates more demand. That drives the prices up more, and that can lead to these violent moves to the upside. Well, it just so happens that Kohl's, the outstanding shares, the short interest is 45%. And the other types of meme stocks that are out there, like Beyond Meat, I was talking to a friend this morning who's paying attention to what's going on in Reddit. Well, they're trying to pump Beyond Meat right now. This is a meme attempt to just force these short sellers to buy the stock back. And in an environment where we start to see these meme stocks really start to pick back up, that is traditionally a period where we have to be a little bit concerned about the broader market. And sure enough, this period right here coincided with a drastic sell-off in the broader market. This period here aligning with the sell-off that happened in August of last year. We see this a lot. We see this happen before we see pullbacks, and it happened last year before the money market spasm that we had in April. It's not 100%, but it's a reminder that money is trying to go somewhere. And maybe there are concerns about valuations, and it's a question of like, where can we play and where can we force this and where can we make money move to try to create these violent moves upward on these stocks that are being heavily shorted. So when people asked me yesterday, what do I think of Wolf? Someone asked me that yesterday. I tell you, I think it is a company that's ultimately going to go bankrupt. But that said, right? That said, it doesn't change the fact that you can have these short-term squeeze moves that are forced by these types of activities by the Reddit crowd, who are retail traders who are actively trying to force the short squeeze. They are buying the stock. They are building up their army of people, and they are trying to get people to get to drive this stock higher because it creates that circle of purchasing, right? That self-fulfilling prophecy, if you will, right? That creates demand. So what are people looking for, right? What are the things we're trying to pay attention to really identify where these opportunities persist? And these are some key factors that may signal a short squeeze. And I'm leaving one off because it's very important. But high short interest afloat is a signal of this. Strong momentum is a signal of this. Money has to go somewhere. So companies like Beyond Meat, 39% of their outstanding shares are being shorted right now. And by the way, there is not a company in the world that I dislike more than Beyond Meat. Get that stuff out of my grocery store. Get it out of my house. Don't bring it near me. Kohl's, which just ripped, was a 45% short interest. Wolf is at 49%. Hims, which has had violent moves this year, 36%. Groupon, 35%. You know a lot of these names. Virgin Galactic, 32%. Big Bear, 31%. People ask me about these companies. I'm telling you right now, their balance sheets are problems. Interest rates remain elevated. They don't have a lot of places to go. They're not going to get a bailout. They're not going to get bought out unless it's by a private equity company buying them at an outrageously low multiple that still doesn't cover their debt issues. A lot of these companies are not going to be around in 3 years. But that said, some of them will survive and some of them will squeeze and some of them will find capital somewhere. The point of this is that every now and then there are these periods where we see these violent moves upward. So rising volume after a long downtrend is a very important thing to pay attention to. What do we see in July here? Well, here's Wolf Speed, not a lot of things going on. And then all of a sudden we start to see volume, right? What do we see in KSS? We haven't seen a whole lot of good happening in this. Like volume isn't really moving on coal. So something else had to be occurring. Wolf, we certainly see it. Coals, we do not. We start to look for catalysts and earnings beats. Space, for example, SPCE had momentum building into its previous earnings report. And it beat earnings expectations and it squeezed only to give back all of those gains and go back toward all-time lows. And in this environment where momentum is improving, and we've seen a lot of capital spill in, once again, Space getting this move from 290 up to 444. What is an important thing to pay attention to? The 20 and the 50-day moving average. I can't stress this enough. When you get above the 20 and the 50 on some of these names, it's time to buy a very small option out 2-3 weeks and let it play like a lottery ticket, because some of this stuff can really take off. One of the other things that you can do is maybe sell a spread and look to go to the upside. But these things happen above their 20 and the 50. You don't start to see the squeeze really transpire, those big candles, until we're above those moving averages. Okay? That said, what do you do to target it? Well, identify the trade on the short squeeze, right? You want to screen for the high interest stocks. Well, that's done for you. Highshortinterest.com has all of those names. It's available. You want to look for technical breakouts over the 20 and the 50-day moving average. You want to monitor volume spikes on green days. You want to confirm that the prices are holding key levels, which again goes back to those 20 and 50-day moving averages. And you certainly want to keep a tight stop below the prior support or volume weighted average price, which is one of the key ways that we trade. Or you could just join Ghost Prints, because once again, this is one of the most recent stocks that Brandon identified that, yes, it had high short interest focus, but there was other elements that he saw a couple of weeks ago that beat this, that you didn't have to see it above its 20 and its 50. There was activity that he was seeing before we even got there. And people were up 60, 70% on a trade with KSS, right? Before it got above these levels. And they're saying, should we take our 70%? No, because they're looking for the big move. These are the types of things that we are looking for as traders. And once again, we don't care about the fundamentals, because we are looking for these every now and then violent moves up that transpire because of the way that the market operates. Coles is not going to deliver massive moves multiple times a year. It probably will get you one or two, just like I've talked about when it comes to broad momentum downturns and upturns. You're going to get one or two. But when you have this large number of stocks and these large number of companies, and you know exactly what you're looking for, as Brandon does, this is the type of thing that is possible. 350% moves, and that is what can make your year. This type of trading style can make your year very, very quickly. And then during the other times, you just spend and you wait and you be patient and you take what the market is giving you. Most important thing. Not Brandon in Idaho. So, yeah. Was it Idaho? I thought he was in Montana. Maybe it wasn't Idaho. I'm blanking on things today. Yep, you're right. Idaho. All right. Last thing as we wrap up the day. So a year ago, on March of last year, March 2024, I wrote a report called The Hedge of Tomorrow. And it was basically an outlook for the next 18 months. So that was March 2024 into the end of this year. And what I was effectively arguing was that the structure of the financial system has drastically changed in the last 5 to 6 years. And it's slowly that people are finally catching on to what we've been writing about and talking about at the macroeconomic level. And the idea here is the entire financial system has $300 trillion in debt. $300 trillion in debt. We never pay that debt off. Instead, what we do is we refinance that debt. Now we're doing it at 4.5%, 5%. We were 5 years ago doing it at 0 to 1%. Well, here's the problem. The amount of capital that is available in the global financial system, the M2, is 110 trillion, according to the IMF. The liquidity figure, though, the actual capital that can be used to refinance existing debt, according to cross-border capital and people like Zoltan Posner, is 175 trillion. So you have 175 trillion in capital liquidity to refinance 300 trillion in debt. Do that math. What this means is over time, there has to be new capital creation to refinance existing debt, and new existing debt is exponential. It is a bell curve, and it is expected that in the next 10 years to 15 years, that global debt figure will hit $600 trillion, which means liquidity is going to have to keep up in some capacity to refinance all that debt. Okay, so what does that mean? It means that, look, you want to really understand where capital is going to flow. It's going to flow into places that can kick off a lot of cash that can be utilized for the purposes of paying off other debt, whether it's at the sovereign level or at the private equity level or in the hedge fund level. So what do you do in a world of expanding debt and expanding liquidity? You have a focus and a strategy. And when we laid this out, we effectively made the case for gold at 3,200 within a year. We just hit 3,400, and we're probably heading higher. We argued that Bitcoin, when it was at 60,000, probably was going to be pushing the 100 to 110. We're at 120 right now. The liquidity upside of Bitcoin in this cycle is probably in the $150,000 range. We still see silver as a significant opportunity. And that said, what's so important about it is there's ways to utilize gold outside of just owning the rock, things that are like gold royalty companies that own the rights but do not have to actually engage in the production and kick off cash to their investors. We talked about the idea of fortress stocks. These are companies that have high return on invested capital. These are the types of things that Warren Buffett invests in. They kick off a lot of cash. We talked about risk stocks. Smart risk stocks are high F score, high Z score, low risk companies that have drastic upside because they don't have any debt that they need to pay. We talked about capital efficient assets. They include things like data centers, things that have one-time investment, and then from that point on, they kick off cash. Money market funds at 4.5% are kicking off cash. And finally, pipelines and infrastructure, which is what sovereign wealth funds invest in. The point of this entire thing is these are the types of things that I put my money into because I want it to kick off cash for multiple reasons. The one being, I would want to try to generate a yield somewhere in the 7 to 10% range if I can. And that money that I generate, because the assets are going to appreciate in value because of the underlying system itself, and they're going to help protect against inflation. That 7 to 10% cash that's being kicked off is money that I can use to trade. So I have a naturally built inflation and wealth protection built in these types of names. And then I have cash that's coming in that I can use to speculate or trade or focus on opportunities ahead. So that is going to be the purpose of our conversation today at 12:30 when I'm here in the member room. We're going to dig into this a little bit. And the goal here is to provide at least 5 or 6 different types of names that will provide that type of protection. And then we get active in trading tomorrow with Tesla earnings and Google earnings and all of the other major players over the next 10 days. It is 9:21. Don is coming up next. I hope you guys have a great trading day. I will be back in a little while. I need to try to figure out how to get out of this because I am, again, on my other computer. Let's see, making sure that we got it. Good. No worries, UK Ray. Good to see you. Hope you guys have a great day. Rosario, thanks, everybody. Don coming up in a couple of minutes. Some music's coming on. We'll see you in a bit.